this allowed people to borrow a lot of money, and as a result, a lot of that funneled back into the banks, which would have been the smart place to keep it. However, like I mentioned earlier, when banks take your deposits, they don't just keep it sitting idle in a vault. Instead, they lend and invest your money with the expectation that they would be able to make a little bit of profit and pay you back some interest as a reward for keeping your money with the bank. Except this time, it didn't exactly go as planned. That is because US banks had so much money during a time where interest rates were at record lows, and because they had such a big surplus, they invested a large chunk of those proceeds into low-yield US treasuries, which plummeted in value once the Fed began raising rates. Now, in a normal market, this wouldn't be that big of a concern since the banks still technically have the money locked away until the loans mature, but smaller banks were the exception, and when their customers began withdrawing all of their money at the exact same time, that caused a liquidity crisis which eventually resulted in 3 banks completely collapsing. So what does that have to do with today? Well, just like the banks of 2023 had their money tied up in low-yield US treasuries that had lost a significant amount of value, today's banks have their money tied up in another asset class that's also not doing well, and that would be commercial real estate. See, during a time where treasuries paid you next to nothing and bank deposits paid you less than 1% interest if you were lucky, commercial real estate was booming because you could borrow money at 1 to 2% to buy a property that earned you 3 to 4%.